Please be seated and we'll get started. I've had many wonderful meals in the city. I'd never had sushi before lunch, so that's a new item on my menu in Spain. Please have a seat and we'll get started. Ladies and gentlemen, let me introduce Sarah Breeden, the Deputy Governor for Financial Stability, and because the "and" has a whole lot of other things associated with it as well. The title really doesn't capture the full breadth of the number of functions that she actually plays at the Bank of England, and does so with great joy and intellect, and is always open to the industry's ideas and thoughts. And so we've developed a great relationship over the years. Thank you. I'm glad you're here. We've both been enjoying this beautiful sunshine. I know you're glad to be here.
Yeah, absolutely fabulous to be here. And thanks to Santander for putting such a great program of speakers together. You get a real shot in the arm on the issues that are current in central banking and finance and the globe. It's great to be here. They
do a great job. Let's get down to brass tacks. This morning we've heard an assessment of where the European Union is in terms of the regulatory approach, but the philosophical as well as the actual practical day-to-day applications of regulations. I thought Anna did a fabulous job this morning of walking us through the challenges. We just heard Mickey Bowman up here a few minutes ago giving a very different perspective. And the U.S. is truly in a different philosophical place, a divergence without question, and hopefully Europe will figure out a way to minimize that divergence. There you are in the North Atlantic, looking east, looking west. Where are you in this spectrum in your approach to regulation?
So look, we try, as you might expect from the Bank of England, to approach this analytically. So where does growth come from? Growth comes from capital, from labor, from innovation, and from productivity. And what facilitates that? Stability. Stability creates the foundations on which businesses and households are prepared to invest and drive growth. It gives businesses and households confidence. It facilitates actual investments by providing the financing. And it means that London is an attractive place to do business and support UK firms as they compete overseas. So in that context, I honestly think, Tim, that the single most important thing that the Bank of England can do to support growth is to ensure that as shocks occur, as inevitably they will, as we heard about this morning, we avoid the hits to growth that come with crises and which are longer and deeper than normal recessions. However, we are humble enough to recognize that probably we didn't have every single measure that was introduced after the financial crisis introduced precisely correctly, never mind in the round. And so what we have been thinking about is what are the broad areas where we can do some more work to think about where can we tweak our system to drive growth. And we've got 4 dimensions on which we've been thinking about it. The first is regulatory efficiency. How can we make getting to the same outcome less burdensome, better balancing growth and regulation, more responsive? So that's the first theme. Right. The second theme is responsible innovation. How can we have a regulatory environment that supports the enormous potential of the new innovations that we were talking about this morning, whether it's AI, whether it's distributed ledger technology and tokenization. So that's the second theme, responsible innovation. The third, and this perhaps isn't a surprise given we oversee London as an international financial centre, how can we support safe openness? There are costs in fragmentation. Right. The more that we can be open to international firms doing business in London, the better. And then our fourth theme is productive finance. How can we, through our regulations, ensure that finance is allocated efficiently to the areas that are most supportive of growth? There's a huge amount that's already happened under those agenda items, but there's loads more to come as well. I guess the thing that I am proud of is that we've had a whole load of shocks recently, and the financial system has supported businesses and households and interventions in financial markets through that. And what I want to make sure as we refine our framework on those dimensions is that we don't throw the baby out with the bathwater.
I agree with that. We don't want that to happen. The 4 items that you mentioned are really in the DNA of your country and your government. It has been for some time. And I'll tell you a story. I was in London in the depths of the financial crisis. And I was out to dinner with a hedge fund manager, and he said, I'm buying every piece of real estate I can get my hands on in London. And I said, I won't mention his name. I said, we're in the midst of the biggest financial crisis of our life. You should be selling. He said, Tim, London has been a gateway market for 2,000 years. It always will be. Buy here, and the institutions matter. The Bank of England matters. Your approach to policy matters. That is really an important asset for your country.
Absolutely. And what we try and do is use our privileged position as overseer of an international financial centre the size of London, where there are innovators all over the place. We try and make sure we talk to them, we understand what's supporting their business, what's getting in the way, and try and make sure that our regulatory approach enables people to succeed rather than frustrate.
Well, I'll give a shout out to your chancellor. I know we've got a budget to get out, but she spoke at our board meeting a few weeks ago, and she's an incredible salesperson for the country and for London. She did a fabulous job. And hopefully she won't put taxes on banks. We'll see what happens. But there is a UK secondary objective, which is growth and competitiveness. Growth, it's the most important word we're going to talk about today. What does it mean to have a secondary objective? Is it a distant second? Was it just crowded out by stability? Is it close by? How do you think about it in terms of balance with the principal objective?
So I honestly cannot underplay the importance of that secondary objective for competitiveness and growth. It has made, and it continues to make, a real difference to everything that we do. So it matters when we're making policy. So we've set out our new rules for Basel 3.1, introducing that in the UK. It has affected the substance of those rules because we've brought in adjustments for SME lending and infrastructure lending with an eye to that. It's affected the timing of our introduction of those rules because when the US are delaying their implementation, we had to react accordingly. That's the secondary objective, real and live in action. Mickey talked earlier about tailoring. We've brought in a strong and simple regime that will go live when Basel goes live. It's a whole new regime designed for smaller, less complicated banks that deserve a simpler, less complicated regime to comply with. I'm not sure that any of those things would have happened without a secondary competitiveness and growth objective. And I also want to emphasize one point as well. It's not just what we do, it's how we go about doing things as well. We have to appear in front of Parliament to explain what we're doing. That's part of the accountability of being a regulator. Knowing that you're going to be in front of Parliament explaining what you've done on your secondary competitiveness and growth objective really does drive different decisions. It's changing the culture of the place, it's changing the information that we look at when we make our decisions. We're encouraging research on it. We have an annual report on what we've done. Look, clearly there's more to do, and changes like this take time, but I honestly would not underplay the importance of being asked by Parliament to take competitiveness and growth into account as we go about doing our jobs.
And the culture is changing. Is it works its way down the system? People get it. They're changing the way they do business.
Totally. We train people on it. We say what it means and what it doesn't mean. To your point about how does it interplay with the primary objective and the secondary objective, we're making this real and practical for every member of staff.
Capital levels. We used to talk about capital frequently. Now it seems like we've moved on. Most of the focus for many regulators has been on operational risk and other items. Capital in the UK is broadly where you want it to be?
So we have just announced that we are doing a refresh of our capital stack, and we're midway through that review process. We'll be looking to put the results out in December. It's a really thorough review. Having had our capital rules in place for the best part of 10 years, as we come to the end of implementation with Basel 3.1, we're at the end of that long march on capital. Is it operating as we expected? And is it calibrated, given the risks in the system now, in the right way? So we all know that if there's a macroeconomic cost and a macroeconomic benefit from having capital in the banking system. The cost is that it costs more to lend to businesses and households because you've got to hold the resilience for losses. The benefit is you avoid the crises. So we're looking again at the research around that and thinking, given the risks that we see in the system right now, have we calibrated it in the right place? We'd said 13 to 14%. Is that the right level or not? Second thing we're doing is looking at how it's operating in practice. And this goes to belt, braces, another belt, and then another pair of braces just in case. Right. Are those bits of the capital regime operating in a way that is driving the right outcomes, or are there tweaks that we should make to make them more efficient? My personal bugbear on this, buffers. What we have seen is that we have a series of buffers that banks hold, right, some of which do not operate as buffers. They, in effect, just operate as minima. How can we think about changing the approach to the buffers that the banks have got to hold? Simplification, but changing them. One of the things that we saw in COVID, there's some fabulous research on this, was that with our counter-cyclical buffer, which when shocks hit, we say it isn't 2 anymore, it goes down to 0. Right. So we take the capital requirement away. We don't have it there and say you can use it. We take it away. We saw that the banks that had that happen, because there were different approaches across different jurisdictions, those that had their capital buffers released lent more. So it's not just simplifying, it's changing its structure so that it can properly be used. Second thing, leverage ratio. In my head, when we brought the leverage ratio in, I thought it would be there in the background, kind of being not quite a backstop, but not routinely binding on firms. When we look at the UK banks right now, it's binding on quite a few of them. So I think it's on us to look and say, why is that happening? Risk weights have come down. Is that reduction in risk weights because the degree of risk on the asset side of the balance sheet is lower? What does that mean about how the leverage ratio is operating in practice? And I use those two just as examples of the kinds of things that we're looking at to just say, is this system operating as we expected?
Well, I applaud that effort. We've made the same case to the Basel Committee to do it on a systemic, broader base. So far, not much of a response. Yeah. They seem to be pretty happy. But 7 years since we were in Santiago when we had this package put together, it's time to ask the question, did it work as intended?
Exactly right. And as Governor Bowman said, we're all going through a version of this, right? Every Basel Committee member is having a version of this debate domestically. So maybe now's the right time to put it back on the agenda.
I want to get to the digital innovation, but let me just throw in one other question on MBFI, private credit. the governor has been very, very focused. Every time I see him, we talk about this particular topic, the opacity of parts of the financial spectrum. How do you at the bank think about non-bank intermediation?
So let me start. Non-bank intermediation is a good thing. Having two sources of finance for the real economy is better than having one. However, it needs to be resilient in the way we expect bank finance to be resilient. And what we see in private credit, the private finance ecosystem more broadly, is aspects that make us worry. It's grown incredibly quickly in a low interest rate environment, hasn't experienced stress, weak underwriting standards, leverage on leverage on leverage, financial engineering, complexity, interconnections, many of which remind me of the GFC playbook. Now, just because those features are present doesn't mean it's macro relevant, that it matters at the level of the economy. So what we're doing is working with the industry, working with the investors, working with the banks, working with the insurers, and we're going to do a system-wide exploratory scenario where we try and play through how would stress in the private finance ecosystem manifest as a desktop exercise before we find ourselves in it.
Including bank exposure to the private.
Exactly. So it will have the banks, it will have the insurance companies, because private equity owns insurance companies, that owns private credit, that's reinsured to other reinsurers. So we'll have all of the players in the ecosystem in.
Is this regulatory arbitrage? And I ask the question because when the current Prime Minister of Canada was the governor of the Bank of England, it's got a long resume, Mark said to me, look, we're moving risk off the balance sheet, bank's balance sheet. And I said, okay, where is it going and how do you know where it is and how do you worry about it?
So there's some risk that shouldn't be on banks' balance sheets, right? High risk lending should be backed by investment risk capital, not depositors' money.
Right.
But what we need to make sure is the complex ecosystem in which banks are involved, including the macroeconomic consequences of that risk being provided by private credit. We need to make sure that we've got our arms around that, and that's what our exercise is designed to do.
Let's move in. We only have a few minutes, unfortunately. This is quite delightful. I talk a little bit about digital innovation, and that's in your remit. And as I told you, I was listening to podcasts this morning. David Sachs is the White House advisor on crypto and AI on Mark Andreessen's podcast. And the world they described in terms of DeFi and crypto, it sounds magical, mystical, and it sounds revolutionary. How with stability still is your primary concern, how do you think about these new financial products, including stable coins, with respect to your remit?
If there is a form of payment that's out there that is purporting to be money and is being widely used as money, either in the real economy for retail payments, for cross-border payments, or indeed in wholesale financial markets, if it is purporting to be money, it's my job to make sure it is going to behave in practice like money. What does that mean in practice? For those stable coins issued by non-bank participants, for those that are widely used for payments and settlements, they will have to be regulated by the Bank of England. Their backing assets need to be a combination of reserves held at the Bank of England, deposits with me. I'll be the banker to the coin, not the commercial banking system, and short maturity, high quality government assets that we will also be prepared to monetize through a discount window facility, lender of last resort. And what that means is a stable coin will genuinely be stable because the assets can be turned into fiat through me as the central bank. The extra thing I want to emphasize, and it goes a bit to some of the discussions this morning, is it's really important that this form of money is interoperable frictionlessly with all the other forms of money in the economy. And so that requires these coins to have access to the payment system as well, so that normal deposits, tokenized deposits, stable coins, central bank money are all freely interchangeable. That is something that has been absolutely core to the design of the Bank of England's stablecoin regime. We're different to every other regulator of stablecoins in this respect. And it's because we're regulating for future use when this has taken off and is being widely used, not just the current uses.
But if we have tokenized deposits, tokenized assets, we build the cross-border rails, which we're working on, Project Agro. The Bank of England is central to that. What is the use case for stable coins if you've got this over here and the central banks are part of that and you have tokenized central bank money?
Well, then it's a competition, right? Kind of whether it's stable coin, tokenized deposits, traditional deposits, I don't mind.
You don't care.
My job is to ensure that the infrastructure, hard infrastructure, the rails, soft infrastructure, the regulation enables these technologies to be applied in the real world to real financial transactions in order to support businesses and households and users of financial markets. There is, though, one really important point. What do banks do that's special? They bundle payments and credit. Right. And one of the things that I weigh very heavily as we enable stable coins to be safely used is that we must not, as we enable this new form of money, have a precipitous drop of credit in the provision for businesses and households. So we will ensure that we're thinking about the ecosystem as a whole, including the important role that banks play in providing credit. And in that context, can I just underline to all of the banks, please do take this technology, point it at your your deposit base, make them tokenized, and continue to support credit to businesses and households.
Without question, my job is to keep us on time, in which I failed. We're already out. This has been a delightful, as it always is. Ladies and gentlemen, please give a round of applause. Sarah Breeden.